Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan interviews Keith Weiner, founder and CEO of Monetary Metals.
And today, Corey and I will talk about bonds and bond yields and GDP and banks and all kinds of stuff.
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. Bonds are so darn exciting, aren't they?
Bonds, stocks and bonds. Everybody loves bonds.
Yeah. Bonds are potentially very exciting because, if there's stress in the bond market, that's not good for equities. And, as we speak here, the action in equities has been down to down.
Yeah, since this whole month, really. Yeah, equities have been down. The bond yields have been doing things again, I would say.
Yeah, I tend to think more about spreads than yields. Maybe you should talk about yields and I'll talk about spreads.
No, I mean, yeah, I'm along the same lines as spreads. I mean, the 10-year Treasury yield is back to where it was in October back of 22 when stocks bottomed. And then also, if you go farther back, same level as 2008. So showing that higher for longer environment is pretty clear, I think, to a lot of people now that the 10-year yields, which is widely followed, is going where it's going. So, and then the spreads, I'll let you talk about. There's some interesting stuff going on there at the same time.
There is, but it's like really near term and really not huge. I mean, if I'm looking at B of A, high yield index option adjusted spread, that's a lot. That's a mouthful. But it's the Bank of America high yield spreads, junk spreads. Going back to like maybe July last year, close to 6%. Well, 5.99. I'm going to call that 6%, but now below 4%. And, moving a little bit lately, but not like I don't see the distress. I don't like in the stock market, it looks like somebody's not happy about something, but I don't see that distress in the general trend of spreads.
Right. Yeah. I'm with you on the high yields. Yep.
Yeah. I keep seeing people talking about it, but I keep looking at the data and I'm like, what are you looking at here? I don't see what you're seeing. So that's where I am on and high yield spreads to me, it's like it's the next thing up from equity, sort of. Equity is the most risky part of the capital structure. And then the next thing up from that is sort of high yield or junk bonds. And you figure, well, if there's distress in the junk bond market, that's not good for equities. And equities look worse to me than high yield spreads right now.
Correct. I agree with that. I'm also looking at the spread on like the 10-year and then the 2-year, right? That inversion, which has been in place for over a year.
Yeah.
And has been a recession indicator. I've written a lot about this. I've a yield curve. I've gotten a yield curve nerd, perhaps. When it inverts, which it did last spring or summer, a recession is typically followed, but between 6 and 24 months, right? That's been the range. So for that recession to officially arrive. So we're approaching the back end of that range. And now recently the 10-2 spread is starting to inch back closer to, is reverting, I would say. So like while the 10-year yield's been going up, the shorter term stuff has been, and the 2-year and everything below has been either the same or going down slightly. So those spreads are narrowing. And so the curve's kind of early signs of getting back to normal. And the reason I bring this up is because this behavior has happened literally before every recession going back 50 or 60 years. So like this is the point where that recession that everybody's been waiting for. It seems to me that I'm seeing some signs that more people in the market are preparing for that to actually happen now. Perhaps like we saw a little bit of this back in March with the bank crisis. Same thing.
Mm-hmm.
The spread started to narrow, but it went after the Fed stepped in. It went back to the same story. In that same kind of inflation gliding down story, everything's fine, soft landing, blah blah blah. Um,
Right.
Now, what you're seeing in stocks now, it could be, who knows? I don't know what's going to happen, but it could, stocks could fall a bit more because I've been along with this, like when this switch happens with the 10-year, 2-year before the recessions. I last two times the curve's been inverted for this long was in 1980 and 81. There are two different times.
Wow.
And both of those times when this happened, stocks went down about almost identically, like 13% ahead of that change. So, we're down like 5% now. Could this be that repeating itself? Maybe. I'm not sure. Or stocks could go up tomorrow if Jerome Powell says something positive at Jackson Hole. But it's an interesting time for me. It's kind of like an interesting situation. I think right when everybody's giving up on the recession, it might actually pop up, late this year, maybe next year.
Yeah, I mean, I really got concerned about a recession earlier this year, and it was, a typical kind of recession call. It just didn't go anywhere. And technically, we did have like 2 quarters of negative real GDP, and I was sort of pinning my hitching my start of that wagon, but it really didn't go anywhere. And now, if I look at like kind of a longer term, a few year, chart of like, home builders or trucking or something, like it doesn't look bad at all. I mean, there's a little, everything's kind of ticking down lately, but that's a very short term thing. I'm just looking at a chart of the Nasdaq and S&P 500. Nasdaq down about 8% since mid July, and S&P down 4.5%. I mean, okay, it is not pleasant, but who cares really at that point? And whether or not, but
Yeah, I think those were like
yeah,
those were what people called garden variety corrections
garden
before
variety,
in the
exactly.
good old days, right?
Now, I will say that I've never said we were back in a bull market, so I think this is a huge, we've seen a huge bear market rally, sort of like the one from I think it was November of 29 to April or March or April of 1930. It was really like hefty, 48% or something like that. Obviously, that was a pretty serious bear market. So, like, I'm still bearish. I still think we're in a bear market, and at the very least, probably a sideways market for years to come. So, I'm sitting here thinking, okay, is all this starting to add up? Is like is the market doing actually pretty well so far this year and going to embolden the Fed? They'll continue to hike. Are trucking and home building and other things rolling over? Is this it? Are we done with this, rather large rally that took, basically a year almost from October to August in the S&P 500? That's a long time. Better part of a year, not almost a year. And I don't know, but I tend to think that sometime before the end of this year, we will realize that we're still in a bear market. If not, I'm going to have to say that I'm wrong about that at some point here.
I haven't been comfortable saying that we were in a new bull market either. As I said before, just because we haven't been over the highs from earlier in 2022, and at the same time, there was a bottom of some sort in October. But I think that was more related to the peak. That was what I've said is the peak inflation bottom, and then everything after that is to me is like new. Like it's not. It's still within. You can still say it's within a bear market. And I like last week when I said I wasn't sure if say another 100 basis points of rate hikes was uh, baked into stock prices, or quote priced in, or so to speak. I think we might be seeing some of that happening right now because our old friend, the Fed Watch tool. I clicked on that, and for the first time, I've seen some bets on a 6% Fed funds rate at some point by the end of the year, and so those weren't even available previously, and now
Right. It
now they
wasn't
are.
on the chart.
It wasn't
That's
on the
right.
chart, and now it's like
Yep.
single digits percentage, but it's there now, and so I think I mean what really surprised me this week was the GDP projection number out of the Atlanta Fed for the quarter is almost at 6%.
It was like 5.8. Yeah, I saw
Yeah,
that.
and so you put these things together, like 6% GDP, 4% inflation, low unemployment reportedly, and like wha- take that on its own. What would anybody do as a monetary policy maker? I don't, you're not cutting rates. Maybe you're holding them the same, but could could easily raise them. Like why not at this point? If you're them,
Right. You're not doing 75 basis points, but you're doing something.
yeah,
Maybe another 25 or something. And Powell made this statement about the effects still lie ahead of us of hikes they've already made. I forget exactly how he put it, but that's what it amounted to. And you have to wonder if maybe they'll just sort of either keep it steady for a while or increase very slowly as the economy. I mean, what you just described is not an economy that is contracting in any way, and we know that employment data too is like huge multi decade lows in unemployment. So I would be emboldened to answer your question. If I were a monetary policy person, I would be emboldened to hike. I would be saying, well, if we want to hike and we really care about inflation, we got to, we're still at 4%. And by the measures we care about, we're close to 5% even. And, we got a lot of basis points to wipe out there. So we better get to
right.
wiping out.
Yep.
I don't know.
That's yeah. No, I'm with you. I think it's a interesting time here for me again.
Yeah.
Just looking at
It,
this.
it feels pivotal to me. It really does. And like when I look at like KRE, the regional bank ETF, or KBW, the larger bank ETF, I feel like they're at a point that could be really pivotal for them, because they bounced off the bottom in May, and then they've rallied nicely through, actually the first week of August. But then, they're off with everything else since. So if there's weakness in the banking system, which, according to Moody's and maybe now Fitch is talking about downgrading, maybe even JP Morgan Chase,
Right.
like the biggest freaking bank in the world, the one that we all know is never going to be allowed to fail.
Yeah, I like how they worded it. That they said we're
Yeah.
going to have to downgrade you. Because
Yeah.
we might have to downgrade you. Like, okay, well, it seems like
But
you already should if you might have to.
yep, if they downgraded the federal government and that's the thing that makes it too big to fail, I guess you have to downgrade the too big to fail, right?
Yeah, no,
I agree.
a lot of, and like if you look at technicals a little bit too, a lot of or all of the indexes have, which were pretty extended, on this bullish run, have fallen through like the 50-day moving average already. S&P is probably about like 5 or 6% from its 200-day moving average if it still keeps, if this turn continues. And so again, you would add that up, it'd be about like a 10% correction, which seems appropriate for given what we've seen so far. It wouldn't be the end of the world, but and then you get to that point, you see what happens, what the world is like then. But yeah, I wouldn't be surprised if a bit more selling here. But then I always think people, I feel like the market always responds to like anything the Fed says. Like will latch on to something positive that, you got the Jackson Hole meeting coming up, and I feel like that will be maybe a stopping point for this, but we shall see.
A stopping point for hiking?
No, a stopping point for like this stock slide. It's
Oh,
like I feel like people just like to hear some messaging from the Fed about, and they're like, "Oh, this will be okay." for
Right.
for a brief moment, because they're expected to pause. I mean, to not hike, and
Mhm.
so if that message continues, that'll probably be well received.
Yeah, so that's Friday, August the 25th. So
Yeah,
we shall see. And the Federal Reserve Chief Jerome Powell scheduled to speak at 10:05 Eastern Time on the 25th. So yeah, markets will be
mark y-
open and
mark your calendar.
yep, they have been they've tended to be highly reactive. I put a bunch of charts. I was just like, the chaos around 2 p.m., the day of the Fed release it's just ridiculous. It's just crazy. I was compelled to put a bunch of charts into the Ferris report to show how highly reactive the market is to this. And so we'll see what happens at Jackson Hole and what these guys are saying. I hate that the umpire is running the game. I really do.
Me too.
Yeah. And with that, maybe we will go ahead and talk with our guest today, Keith Weiner. I follow him on Twitter and I just find him really interesting. And I promise if you own gold, or even if you don't and you just think about owning gold, or maybe you've never thought about owning gold, you should listen to this. And Keith just has a different way of talking about gold. And he runs a company that is very involved in the gold market, and we'll get into that. But I really love hearing from someone who's doing something that I kind of agree with and thought I knew something about, and they just have a kind of a different take on it, an insightful take. So, I've set you up. All right. So now let's go ahead and talk with Keith Weiner. Let's do it right now. NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see what Mark Chaikin's new AI prediction is first. Mark is a regular on many major news outlets from Fox Business to CNBC, and he built the stock indicator Wall Street uses to find winning stocks. His award winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzyreport.com. Again, that's www.aifrenzyreport.com for a free copy of his new report. Keith, welcome to the show. Thanks for being here.
Thanks for having me, Dan.
So I just had to have you on the show because I follow you on Twitter and I really like your feed. You're about as snarky as I am on Twitter.
On a snark scale from 1 to 10, we're both 11. Is that what you're saying?
Something like that. But, sometimes I want to get people on for a different view and sometimes like a combination of, lots of thoughtful views about things. And that's sort of the category you're in. We share an affinity for, well, among other things, if I just look at your pinned tweet here, it is an underappreciated idea of the Austrian school. The damage is done during the boom. The bust does not destroy wealth. It's just the accounting catching up to the reality. And I've been writing lately about how the greatest economic calamity in history is holding interest rates at zero and in some places in the world negative for more than a decade. So I think we're on a similar page there.
Yeah, absolutely.
But we're also both gold guys, I think. I won't say gold bugs. I don't use that word anymore. But we're
I
gold
don't
guys.
prefer that term myself.
Yeah. But since we're not going to use that term, how would you describe, for example, Why start Monetary Metals in the first place, your company?
So that's kind of my origin story a little bit. I founded and built a software company called Diamondware. We made a 3D spatial audio technology for voice communications. It's amazing how many problems we solved and patented, 15 to 20, more than 15 years ago. I sold the company 15 years ago, going on 20 years ago, that today plague us all on these video and audio, conference calls. And, including you plug in a device and it doesn't even figure out what's the right device to use. And anyway, I sold that company in August 2008, days before the crisis really went into high gear. And I sold it to Nortel Networks. It turns out, as a historical footnote, it was the last acquisition Nortel ever did. And so as things are going over the edge, at first I felt very surreal, and then bemused and quickly alarmed, right, that all this stuff is happening, and none of the mainstream stuff. I mean, even Investors Business Daily, Wall Street Journal, Financial Times, nobody really seemed to start at the beginning. They just kind of were starting in the middle. Well, you see, there's too much money, and they print it, and there's even too much more money than there had already been too much, and then that's caused the crisis. And I'm like, what? So I started to study obsessively to just try to figure out how to protect myself. It wasn't an interest in economics. It was an interest in, I'd worked 14 years to build this company, had a good exit, a good liquidity event, sitting in cash in a couple of too big to fail banks. What do I do? And the more that I studied, the more I realized that there's a broken monetary system. That's the root of it. It's not real estate. It's not the Community Reinvestment Act. It's not, the banks aren't regulated enough, as some people tried to say.
That's a favorite of mine, by the way.
There's not enough regulation.
The banks aren't regulated. Yeah, it's just a favorite of mine. It's ridiculous. Anyway, I interrupted. Continue.
No worries. So, the monetary system is broken. And I said, okay, well, maybe I don't necessarily have all the answers, but clearly gold has to be part of the solution. There's an axiom in medicine that whatever caused the disease, more of it won't be the cure. Like if you're an alcoholic and your liver is dying and all these things, more alcohol is not can't be the cure, right? So gold, banished, since 1971 from the monetary system at least, re-legalized for possession for American citizens in 1975. But by that point, it wasn't a monetary thing anymore. It was a speculative toy that you could bat it around in the futures markets or whatever.
Mm-hmm.
And I said, okay, gold's part of the solution. I want to be part of the solution. In a normal world, I would have done another software company. I mean, my team had followed me to hell and back. They were saying, hey, when are we going to jump to another company? I had access to capital, advisors. I think I was actually knew what I was doing by then as a software, CEO. And I was like, no, I'm going to go in a different direction. I'm going to be in the gold space because I want to be part of, fixing this. And so monetary metals, we're a bit different. And I don't really want to try to plug the company here, but we're not about like promoting the idea. And this is the gold bug idea, right? Buy gold because the dollar's going to be worthless by tomorrow morning. And then, gold's going to go up. So then, gold being up, you sell it to take profits in the form of more of the dollars you just said were going to be worthless by tomorrow morning.
Exactly.
And I fundamentally don't get that. And I piss off a lot of people every time I talk like this, and I can't help myself. I've got a big foot and a big mouth, and I just, foot and mouth disease. But I don't get that. And so monetary metals is about paying interest on gold. If you have gold and gold is money, and those are, certainly my beliefs, then you should get money on your money. You should get more gold in the form of interest. And it turns out that's how the world's monetary system is going to be redeemed. There's a lot of interesting economic, things that come out of that. It's a bottom-up entrepreneurial free market gold standard, assuming we scale. And the motivation, I want to make money, of course. Every entrepreneur does. But the motivation is to try to help the world rediscover a gold standard and return to honest money. And it takes an interest rate to do that. So that's what I'm doing, and that's why I'm doing it.
I find this very interesting, especially with all of the, just if I can generally throw it in a category of crypto staking, people basically earning interest on their crypto. And I like you as a sound competitor to that idea because I always have the same question. I think I know the answer. I'll let you answer it, but I always have the same question. I really don't understand where the interest comes from in crypto. Ultimately, I don't. But
Well,
it
that's
comes from a very real market demand in the gold and silver space, doesn't it?
Yeah, I was going to say, to have a sustainable and scalable yield or interest rate, you have to be financing productive enterprise, right? So you're either enabling production to happen at all,
Exactly.
or you're enabling a growth in production, right? So a productive company adds another tool and then they double their output. And the interest that the lender makes as part of the increase in profits due to the increase in production, which is financed by the investor. And it seems to me in crypto, the whole idea is to be an internally self-contained, software ecosystem, which it's
Yeah.
like self-referential.
Yeah. Yes, exactly.
We're all going to sit here, in a circle, and I'm not going to use the really rude term that a bunch of fraternity boys perhaps might use in this situation, but
Yeah.
um,
Yeah.
we're all going to sit here in a circle, and somehow, interest is going to magically, grow and compound. And at the end of the day, right, everything would seem to be working as long as prices are rising, because really what it was increase in leverage. You're borrowing crypto in order to dump it so you can get more dollars or USDT, I think, and then buy more crypto, right? So as long as the price is going up, everybody appears to be winning. Getting back to my quote in my pinned tweet on Twitter. Um, and then, you're just buying more and more and more, and leverage is going up and up and up. And it works like any Ponzi scheme or pyramid scheme works, so long as prices are endlessly rising. And then the moment the prices refuse to continue to go up, then everything blows up. And, the bad guys, it's discovered that it was a well-known insider secret that these guys were cheating, and all kinds of malfeasance was occurring. And in one case, the guy pushed a button and moved $10 billion of client assets to an offshore LLC that he's the sole owner of. I'm like, what company would even have a button where you could even do that? I mean, anyways, but leaving that
Yeah.
aside, the whole ethos is get rich quick. It's not surprising that the companies built on that ethos thought the same thing. And if you're trying to build a company to get rich quick, then, you find that it's easier to build a scam than do something real. And so, the whole thing comes down, and there's a lot less today offered in terms of yield on crypto, because a lot of the guys that were offering it are now under indictment or in prison or bankrupt, or some combination of all those three.
So I've sort of set our listener up there. Right now they're wondering, okay, the yields on crypto are phantasms, but how do you get the yield out of gold and silver? Explain that to me.
So there are a lot of different companies involved in the gold industry that need finance. So we have two programs. We have a leasing program. That's for companies that need a physical. This is physical stuff. It's not a financialized, leverage, hypothecated kind of thing. Let's say you're a jeweler, a manufacturer, and every day you buy a certain number of fresh bars of gold, and then you put them through a process where you squash them into rollers, and then you cut out little shapes, and then you have to bend them and polish them and weld them and whatever. And it takes a few weeks to go through the factory. And then every day you're buying X amount of new gold, but every day you're selling the same amount, essentially, of finished product. But there's always in your pipeline, let's say, 1,000 ounces. You need to finance that. I mean, that's, almost $2 million. So you could borrow $2 million to buy your $2 million worth of inventory. The problem is, if the price of gold, so let's say you did that not too long ago at $2,000 an ounce, and now it's $1,900 an ounce. I haven't looked at the gold price today, but I think yesterday was 1904. Goes to $1,900 an ounce, which is a 5% drop. So now you have a $1.9 million asset, but you still have a $2 million liability. 10% drop is a calamity, on the asset side of your balance sheet. So, anyway, so you can hedge it, and whatever people say, just hedge. I won't go off into my rant about the word just, conceals a small saga of things
Just
you have to
has
do.
to.
Yeah,
Yeah.
hedging is a bigger deal, and it requires more capital, and there's moving parts and risks and costs and all those things. But or you lease the metal. So that's what we do, is we provide a lease. Then they have that 1,000 ounces. They don't have the price exposure. They operate their business to make a spread. That is, they're buying gold at the price of gold. they're selling jewelry at the price of gold plus, let's say, 20%, and they're in business to make that 20%, but not to bet on the price of gold. We also have so there's a lot of different industries. If you think about it, refiners, mints, bullion dealers, jewelers, high tech manufacturers. There's more than half a dozen verticals that need gold as inventory or as work in progress. We also have a lending program for companies that have a gold income, and the obvious example of that would be a gold miner. They literally pull gold out of the ground, then they sell it for dollars, and then they declare in their financial statements they have a dollar income. Imagine giving somebody a bar of gold, let's say for Christmas or a birthday present, and you wrap it in paper, and but you pretend that the paper is the real significance of it, and and of course the 13 or 15-year-old kid can feel that there's some heavy metal in the middle of it and tears the paper off. So they have a gold income. That's what they pull out of the ground. They have the same thing, right? If they borrow dollars, the price of gold drops. They can get squeezed because the liability is going up relative to the income. But if you borrow in gold, then it just makes it simpler, easier to run the mine, takes risk out of the equation. So we're financing mines. There are other companies that have a gold income, and we will be announcing deals for those when they come up. And we're doing leases to the industry. These are all real businesses, jewelers, companies that are doing real things. This is not a self-referential. We're all sitting here in a circle in our software platform, magically levitating, and that's the difference.
So I don't know if we could talk. I'd like to talk about gold in general. It's an interesting time for it, I think, because of, I guess, what one of our previous guests, Brent Johnson, would call, the milkshake, the giant milkshake that was poured during the COVID era by all the central banks in the world, and lots of fiscal stimulus too, was created at that time, and and then of course this year we get bank failures, three of the four largest bank failures in U.S. history, and then Moody's just downgraded 20 or took various actions on 27 banks. Fitch is talking about taking actions on banks. So it's the kind of time when gold is on people's minds.
Absolutely.
Yeah. What I wonder is, am I right? Am I really right to have gold on my mind? Is that just part of the answer to all of this? Like, why do I really want? I know the reasons why I would say that I want gold. Is it really going to function that way? Because in um, 90 years ago, they just sort of outlawed it and said you weren't allowed to, you're not allowed to have it anymore. So
Right.
I wonder what are the odds of something like that happening again? I mean, how much, how afraid are we of, do we really think we'll be able to use our gold? You know what I'm saying? If gold becomes that important to individuals and not just to central banks who have been buying it lately, would the government take action that would sort of negate all this interest that we have in it?
I mean, my caveat to that is nobody can predict the future madness of politicians. The present madness is already unpredictable enough. And there's no telling what anybody might say or do. And particularly when the people are demanding, emergency measures and getting emotional about it. And, but that said, I'm controversial in the gold space for arguing that no, there's no confiscation coming because they had FDR had two reasons for confiscating in 1933, both of which are inapplicable today. The first is at that time you weren't buying gold, you were redeeming, right? So you deposited your gold in a bank and you got a piece of paper, which is your right to withdraw your gold. Now you could pass the piece of paper to somebody else, and then it was his gold and he's withdrawing it. But it was a withdrawal, and when you withdraw credit from a bank, you force them to sell an asset, which is doing two things. It's forcing the bond price down because they have to sell, which forces interest rates up, and Roosevelt wanted interest rates down. He was absolutely an admirer of Keynes, and Keynes would drive the interest rate to zero. And secondly, this was, of course, causing great distress to the banks and causing bank failures and obviously bank runs. And so he wanted to end the bank runs So if you make the currency irredeemable, there's no such thing as a bank run anymore. Not that way, anyways. And stabilize the banking system and push the interest rate down rather than up. Today, there's no such thing as redemption because no bank deposit is a gold deposit. They're all deposits of irredeemable Fed credit slips. And so gold has nothing to do with the banking system today. They don't have to care. And so I had on our podcast, the Gold Exchange, I had Daniel DiMartino Booth, and we were talking about this idea of does the Fed care about gold? And she worked at the Dallas Fed for 9 years, which we're writing a book called Fed Up, which is an interesting book. And she said in 9 years of being at the Fed, nobody ever asked her any kind of research report on gold. Nobody talked about gold. Nobody thought about it. Nobody cared about it. And she's had conversations with, he calls himself Fed Guy. I want to say his name is Joseph Wang, who's also become somewhat of a notable personality on Twitter. And he was at the New York Fed, involved in the open market operations. And he has said the same thing to her that she said to me, which is nobody at the New York Fed was asking about it, thinking about it, asking for any analysis or research reports on it. I just don't think they care because it's not a banking system asset anymore. It's just not something that they follow. Now, to your point about Brent, I've been saying, but not in as pithy a way, for a long, long time, that the basic scenario is all other currencies down against the U.S. dollar, and that the other currencies are all U.S. dollar derivatives, anyways. That the idea that the dollar could collapse and its derivatives could survive is absurd. But that has nothing to do with the price of gold in dollar terms, and that it's actually the dollar sinking in gold terms while the other currencies are sinking in dollar terms. And so he, of course, gave it the very famous milkshake moniker. And you see now, remember on Twitter, it was not so long ago that everyone said, oh, Putin is creating a gold standard. The ruble is going to be super strong.
Yeah.
All you idiots were shorting it. The ruble is breaking down to multi-year lows again. And if you zoom out and you look at on Yahoo Finance, as far out as it zooms, I don't know if it's 20 or 25 years or something, you look at the ruble, it's just a red line, down and to the right. I mean, it's brutal. Somebody on Twitter was posting, and there are country-specific reasons why, of course. You look at the Turkish lira, I mean, that's a total, train wreck, if not a hyperinflationary collapse. There's somebody on Twitter posting about country-specific reasons, internal, he's Israeli, why the Israeli shekel is collapsing, the Argentinian peso, the Chinese yuan is breaking down. And every one of them, you could say, well, you see, what happened was it's this internal country-specific thing, but they're all forced to, and then I was in Zurich the other day talking to, folks I know there that are in the gold and, finance spaces. The Swiss National Bank is now trumpeting that they feel the franc is undervalued. They want you to buy it. And meanwhile, what are they doing? They are selling dollars to buy francs because there's selling pressure. They're defending the franc or attempting to. And of course, that never ends well. So currency after currency after currency is falling against the dollar. And meanwhile, gold is sitting here. Okay, the price of gold has subsided slightly, but in other currencies, it's either at or near record all-time highs, and in the US dollar, not very far from a record all-time high. While it remains unloved, neglected, we are the opposite of the shoeshine boy giving you tips on how to buy gold. Today, you tune into CNBC and they have that little scrolling ticker in the bottom right-hand corner that goes through oil and S&P and the NASDAQ and whatever. And gold used to be once every rotation. And now it's like once every other, once every third. It's a lot less. And completely unloved, completely ignored. And yet here it is, pretty strong, pricing for all that. And I think that, we're in, if you want to call it a bull market in gold or a bear market in dollars. I think that people got very used to, the long pattern we had from 2000, August 2011 through, 2018, which was definitely a sell the blip market. And we're not in that mode anymore. I mean, post-COVID, we're absolutely in a buy the dip market. And the price is pretty clearly heading higher. I may be forced to eat my words on that, but I don't think so. I said, I think the price is high because gold
Yeah.
is the one thing that they can't debase, but more importantly, it doesn't have a counterparty. It doesn't default. If you own a piece of gold, Warren Buffett derides it. You put it in your desk drawer. 20 years later, you pull it out, it's still the same lump of gold. True. And he regards that as a bad thing. And he's talking about its lack of a yield. We've written an open letter to Warren Buffett saying, what you said was true, but no longer. But in terms of owning the gold metal, it's the avoidance of taking the counterparty risk of buying something else, or the market price risk of buying, let's say, real estate. It's a terrible time to do that right now. Gold is the thing you own when you don't want to invest or speculate in anything else. And we're now in times where that's probably a pretty good. That's occurring to a lot of people. That's a good idea. It's not just us gold people that think that. There's a lot of other people that are coming to that.
I'm fascinated just with the simple fact that you turned on a dime from a software career to a career in metals. I'm fascinated by that one fact. When you were originally starting your story, I thought, oh, wow, because the logical thing to do. We see it all the time. A guy sells a software company, he goes and starts another software company.
Right, exactly.
But you got here by wanting to preserve what you had, you told me. And I'm fascinated by that too, because that's one of my standard, people say, oh, gold is stupid. It's a pet rock or whatever, and then Warren Buffett, they quote Warren Buffett and that's the end of the conversation. But,
right.
I think, well, it's been used to preserve wealth for thousands of years, like thousands and thousands of years. And if you ask old European money that's been around for 100 years, how'd you do it? It's like gold, art, land. They don't say, dollars. So
Yes, everybody in Germany would have some gold. Everybody in Turkey has gold. Everybody in India has
yeah,
gold. It's Americans that are, blissfully ignorant about it.
I would say everybody in Asia. Really.
Yeah. So, but to your comment about thousands of years, most people in the gold community would say 5,000 years, and that's what I used to say. And it was relatively recently, like a couple of months ago, that I read. I don't know when this occurred, but I read the article a couple of months ago that there was some warrior king that they found buried in Bulgaria, and he had 6 or 7 kilos of gold in his tomb, including a sheath for his, what. It was clearly ceremonial. It was clearly that they valued it, as something associated with regal or royal or leader class, properties. It was highly valued. And then the tomb dates, or the burial dates, to something like 6,500 years ago. It was like 4,500 or 4,600 BC. So it's actually even longer ago than 5,000 years that people have been using gold, valuing it, treasuring it, hoarding it, burying their kings with it. And I guess I want to put in a plug and encourage everybody. I had a debate organized by the Soho Forum on gold versus Bitcoin. It was hosted at the Mises Institute in Auburn, Alabama, and I was the gold guy, obviously, and I debated Pierre Rochard, who's the Bitcoin guy. And I'll give the spoiler and say I won by a pretty big margin, but I encourage everybody to listen to it because I lay out the case for why gold is money and Bitcoin is not money, and it doesn't, and would never work as money, could never work. And he conceded my key point. I backed him into a corner and he conceded it, and it's right there on the video. You can see it.
Yeah, I don't mind spoiling if you don't. If you want to tell me your key point, I'm all ears.
Well, that Bitcoin will never have a stable value. It can never have a stable value, and because it's not stable, that means it's not suitable for borrowers. Right? The borrowers are, everyone is told Bitcoin's going to go up by 1,000 times. Well, think about borrowing to finance a farm or a restaurant or anything else, something that is promised to go up. Your mortgage is going to go up 1,000 times. So you're buying a house today with a mortgage of $2,000 a month, but they're telling you it will be $2 million a month in a few years. That would be insane. And then obviously Bitcoin is also subject to gigantic, 80% crashes. So how can you tell me that a conservative saver, and in the debate, I use the example of an octogenarian widow. So picture an elderly lady in her 80s, no more income potential, hasn't worked in decades, widowed. Can you tell her to put her life savings into it? If not, then how the hell do you justify calling this savings? And anyways, that was a very interesting section of the debate.
Yeah, we had. I hope people will go listen to the debate. By the way, I do. And where did you say it is? Where can we find it?
It's on YouTube. Just Google Soho Forum. Gold, Bitcoin. Weiner. I mean, there's probably a million ways to find it. Or you can put the link in the end notes for the video or wherever this podcast is.
Okay, sure. That's cool. We had George Gilder on the show, and we talked a little bit about gold with him. And he was saying, look, Bitcoin is not going to work. One of the primary things it doesn't do that gold does is grow with the global economy. We produce new gold because we have a constant demand for it, and we expend capital. We invest capital in producing this monetary asset, whereas with Bitcoin, the supply has been sort of really limited by the whoever, Satoshi or whatever, and it will always therefore be extremely volatile. That's one of the ways that he was explaining the volatility of it, because we know it's not going to grow. So when we see growth, what are we going to see? Bitcoin going to 100 grand or what? So it's never going to really be a responsive kind of an asset, and monetary assets need to respond to what's happening in the world.
That's right. They need to be steady in value, not something that's skyrocketing in value. And that's what gold is. So people deride gold and say, well, gold's not going to skyrocket. Absolutely, you're right. If you want to skyrocket and generate an intergenerational fortune, owning gold isn't going to be that. If you have an intergenerational fortune and you don't want to lose it, well, gold is great for that. And one thing I say to people is that in Geneva and in Zurich, there's countless, private bank boardrooms, and every day in those boardrooms, some patriarch of a family is coming in and setting up a multi-generational trust structure to make sure that his grandkids and beyond are taken care of. Those things always have gold in them. And it's not a matter of price. I mean, the gold could be $2,000, could be $1,500, could be $3,000, whatever the price is. He's always putting, the trustees, the banks are always saying, and it's not a huge allocation. It might be, 4 or 5%. I don't think it's like massive, but there's always gold in those things. Bitcoin, I would doubt it, because nobody has the slightest idea if Bitcoin is going to be around in 100 years.
Right. But is there no role for it? I mean, we're both kind of criticizing it, but is there no role for Bitcoin whatsoever? Is it really just too broken to work?
It's a casino. I mean, there's no role for MGM Grand or Caesar's Palace or the Wynn. Sure. I mean, have fun. And some people have made a lot of money in it. Some people have lost a lot of money in it. If it's entertainment or it's a chance to speculate and, find a way to make a big capital gain in the Fed's crazy casino world that they've created, sure. But it doesn't function economically the way even ordinary currency does, the way the dollar does, let alone the way gold does. So it doesn't play a monetary role anyway.
Yeah. So I think we sort of agree about Bitcoin. Let's just forget about that for a second. But then the next thing that folks will tell me about crypto, they'll say, well, it's not about Bitcoin, it's about the blockchain. And all I can think of is like Long Island iced tea blockchain company and stuff. It just seems too much of a buzzword to me. I don't know.
Well, the cure for that might be the next buzzword, which is now AI. So, for a while, blockchain-based companies, had enormous amounts of capital being showered on them. I think that capital, that spigot has shifted. It's now spraying onto the AI crowd and not onto the blockchain crowd. I mean, I think blockchain is interesting, and I think there's no question that there are interesting and important applications for it. Blockchain reminds me a lot of, as a computer guy, I'm going to go back a few years and talk about a computer protocol, which is called SIP, which stands for Session Initiation Protocol. And, the voice over IP companies got together and devised this protocol for how you do phone calls using an internet and computers instead of phones as the edge devices. And at that time when that came out, everyone was saying SIP is going to do this, SIP is going to do that, it's going to revolutionize the world, and all these things. And at the end of the day, it was pretty much relegated to, when people want to use the internet and your supercomputer, and today, by the way, a laptop or a mobile phone is a supercomputer by the definitions that they had in the early 1990s in terms of how much computer can do. If you want to use that supercomputer over the internet to make calls, SIP, basically won in that space, um, and great. But it didn't take over the world. It didn't revolutionize, the wheel and sliced bread and all the other things that it was, allegedly going to do. At that time, and I suspect the blockchain is going to, there'll be applications where it matters. Supply chain tracking, where you want to know the provenance of the goods. You want to be able to prove either the source of that gold, the source of that coffee bean, the source of that beef. Where did that come from? Whose hands did it go through? If it was in a refrigerated container, is there continuous temperature records of what the temperature was inside? Did it thaw and refreeze or whatever that it's not supposed to do? Great. I think there's applications for that. But to have a token that represents only itself, and that's the ersatz money. No, I don't. That's not the application. So yeah, we'll see some interesting applications for blockchain. Absolutely.
Yeah, we don't have to make predictions. It's just I'm just trying to be a little skeptical about the idea that this sort of ledger system will replace the global banking system. That's the part
banks, right? What is the job of a bank? It's a credit intermediary. You have all these depositors that don't have the amount of savings required to lend to. Most businesses are borrowing a hell of a lot more than what one saver can do, and they don't have the financial sophistication to do the due diligence. So the banks are intermediaries, credit intermediation, and people have lost sight of that, and they call Bitcoin finance. The one thing Bitcoin has never done and will never do is finance anything in the sense of paying for the capital expenditure to increase production. Bitcoin doesn't do that. And nothing in that ecosystem is even targeted that. I mean, the closest thing I get is some sort of P2P lending thing. But then the problem is, who's the one who decides that these 10,000 people all should put in whatever, $1,000 each into this loan? Who decides that that's a good loan? And traditionally that was the banks. I don't see blockchain or Bitcoin or any of these, crypto exchanges, disrupting banks in that sense.
Okay. Why don't I go ahead and do my final question, which is the same for every guest. Like, no matter what the topic, I always ask every guest this exact same final question. And it is very simply, if you could leave our listeners with a single thought today, what would it be?
I think if there's a theme that I always return to at the end of the day, and I'll just use inflation as an example of the theme. Stalin, I don't know if he actually said this, it was just reported to have said this, but everybody attributes to Stalin when he said, one death is a tragedy, a million deaths is a statistic. And so, statistic becomes antiseptic. And inflation is reduced to a statistic. People say, well, how much of the money supply increase or how much the price level increase? And those two are presumed to be cause and effect and more or less proportional, generally in mainstream theory. And I argue they're not, but whatever. But if there's an overarching thought that I always return to, and that is, the root of the issue isn't that consumer prices rise or don't rise. The root of the issue is honesty. If I borrow from you, I call it borrowing, but I don't have the means or intent to ever repay you. And on top of it, I put together a system so complicated that it obfuscates the fact that you're actually lending. You think you have money when in fact you're actually a creditor. And so you think that it's printing money when it's actually borrowing, and you're the lender, you're the chump who's lending to it. So you don't know that you're lending, you wouldn't approve to lend. I mean, I know people who have dollar balances who just absolutely haha, what fools are financing the treasury debt. It's like, you are, but you just don't realize it. And of course, they don't have the means or intent to repay, which number one means, yes, we're inevitably headed towards some gigantic crisis. But the whole thing is ultimately a crisis of honesty. It's a fraud. It's a counterfeiting operation that they conduct. And at the end of the day, what's needed is honesty in any monetary system. And the only way you get honesty is in a free market, because the government's running it. They're running it for their own benefit, and it's just too tempting. It's the One Ring in Lord of the Rings. Even the good characters, Gandalf and Galadriel, are saying, "Don't give me that ring, because I'd be tempted to do good with it, but you turned me into a dark queen, beautiful and terrible, and shake the foundations of the earth and all that stuff." Um, that giving them this power creates that. What was it old saying? Absolute power corrupts absolutely. But at the end of the day, it's an honesty problem, and that's the thing that gold really brings to it. It's not about quantity. It's not about the price rise or fall. It's about, if you have an ounce of gold, that's a real ounce of a real thing, and nobody can just cheat or lie or commit fraud in a ledger or whatever it is. It is what it is. It's that lump of metal in the desk drawer, as Warren Buffett derides it. But there's an honesty to it, and there's no real way to cheat. And if you cheat in a free market, then all the other participants will quickly strip you of their capital, certainly, and you go out of business, and that's a healthy thing. I heard somebody say, and I can't think of the attribution, capitalism without bankruptcy is like religion without hell.
Yep.
But it's a cleansing thing, precisely because it washes away the things that are unsound, and most of the things that are unsound are unhonest in some way. They're attempts to fake or cheat or counterfeit or whatever it is, and that's the root of it, and that's the thing I would ask everybody to ponder when you look at whatever system or whatever scheme. Who's trying to do what? What's the game here, and is it an honest one? And if everybody starts to think more along those lines, we'd have a different political system, we'd have a different monetary system, we'd have different legal system. There's a lot of things that would be quite different. People thought about that in that way.
All right. I like that answer. Honesty. Well, thanks for being here, Keith. I really appreciate you taking the time to talk with us.
Thanks for having me on the show. This was fun.
Yeah.
Hope I added value.
And you will probably be invited back in 6 or 12 months too. So
awesome.
Look
forward to it.
Yeah. All right. Thanks again, man.
All right. Thank you.
Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. The first thing I want to point out that Keith just talked about was when he talked about the ring of power, right? This awesome power of government to create money, and you could say of the central banks of the world. This awesome power is something you don't even want it. You think you're going to do good with it, but it turns you into something that's not so good. I thought that was maybe it's such an obvious point, but I thought that was really important. I think it's important to say basic things like that over and over again, because they're so kind of simple and obvious, just the metaphorical value of the Lord of the Rings story as being a world where they valued their freedoms. They talked about free men in that story, and where there was a threat from this sort of dark power that would highly centralize, right? The one ring of power would highly centralize power. I don't know much about the author Tolkien, but I'm sure he knew all that. I'm sure he knew exactly what he was saying there, and I think that's important. And I think gold can help you sort of get outside of that centralized system, which is another thing Keith pointed out. He said, he doesn't worry about gold confiscation because it's just not part of that centralized financial system that we have. It's not currency, it's not a banking asset, except by other central banks in the world. And the United States does own its token amount of gold. But I think that idea of gold as a way to get yourself outside of the system, the financial system, whatever you want to call it, the banking system, the currency, is really important. And I mentioned, as I have before, that if you ask an old European family, what do they own? It's like land and gold and art and stuff. And Keith was talking about people in Swiss banks opening trusts for successive generations. Gold is always in there. If you start to think that way, I think it gives you the correct perspective. I think short-term thinking is a big thing that catches people up and kind of screws them up financially from like borrowing too much, to get some car or some house or something that you really want right now but can't quite afford, all the way to not diversifying your assets outside of the financial system because you never know what's going to happen over the long term. That alone, like that discussion when I asked him the final question, man, I know it's a free podcast, but that was worth the price of admission and then some. That was really great. And just the whole idea that you can deposit money, there's a way to make money from gold that doesn't, it's not wholly reliant on valuing it in dollars, right? Keith explained how his business works and how they lend gold basically and get paid in gold, and the kinds of businesses that need that service. And then that way he can pay his interest to his clients, and he says they see the interest in ounces build up in their account, and it's a wonderful moment. That's how he delights his customers. That's a really interesting thing, and I'm willing to bet that the more successful he becomes, the more imitators there will be. And I could see that getting to be a very, very large business, because all the young folks who thought they were going to get interest, from crypto, and maybe, like Keith said, the guy who promised them that is now in jail and they lost all their money. They still have that idea. They still want to earn interest, and yet they probably want to go outside of the normal banking system. That's why they went to crypto, right? So I think there's a heck of a good future ahead for Keith's idea, for his business, and for others that imitate him. And I think that he's right when you can't invest in anything else because it's too expensive, and for whatever reason, getting some gold is never a mistake. All right. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.